anybody that thinks that the dollar has a lot of upside to it, I think is making a poor mistake. And quite frankly, it's one of the several bullish reasons why not only has gold gotten to where it's gone, but why I think it can go higher as well. There's this still thinking in the gold business that somehow it should just be somewhere between 1,000 or 2,000. Yeah, a couple of reasons why it got ahead of itself, but it can't really go to 5 or 10,000 or 15,000. And I don't sell it. I don't have anything product that because gold goes to 10 or 15, I make more money other than I invested in the companies that look for it and produce it. But the bottom line is, I think we got to get rid of that thought and think that, yeah, that is legitimate.
Goldman Sachs projects a 25 to 30% decline in the dollar based on historical parallels, while the IMF forecasts a sharp slowdown in U.S. growth for 2025. Kirill Klip, executive chairman of TNRGold, mentioned in his recent tweet that gold's next move is to climb to the next elevated level on its way to $5,000 and over $10,000 after the healthy consolidation stage to digest the incredible gains gold has made this year already. Debt and uncertainty will drive gold to new all-time highs. Financial expert Peter Grandich compares current gold skepticism to the disbelief that preceded past stock market booms. He argues that gold reaching $5,000 or higher is realistic, despite mainstream doubt. Grandich urges a mindset shift and highlights strong gold demand in Asia as a key indicator of the market's direction. Gold will be money when the dollar and the euro and the yuan and the ringgit are mere memories, according to American finance writer Richard Russell. While analyzing the market, Grandich remains strongly bullish on gold, citing Trump's push for lower interest rates and a weaker dollar as key catalysts. He believes these shifts are more bullish for gold than Fed policy alone. Moreover, he notes that global momentum, driven by the BRICS and the Shanghai Gold Exchange, is steadily shifting away from the dollar. Financial research firm Morningstar says the standard metric for measuring the dollar's strength against other currencies dropped by 11% in the first half of 2025, the biggest decline for a first half of the year since 1973. Economists say uncertainty, especially Trump's pursuit of tariffs against U.S. trading partners, may be the most important factor driving the dollar's current decline. Regarding the yellow metal, Grandich notes its rise remains underappreciated by Wall Street, as mining stocks like GDX are still being sold despite strong earnings. He observed bullish sentiment at Rick Rule's conference, but says such optimism is rare in the broader financial world. Before we dive into Peter Grandich's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
I'll tell you what I'm more favorable of. As you know, I don't think there could be anybody more bullish on gold and some other metals as I am right now. I know there's people equal. But he said something, Trump, last Friday that was even more bullish about claiming he wants interest rates cut. He literally said he sees no upside to a strong dollar, and a much weaker dollar was much more favorable to him. That to me is more of an indication and what could be coming our way and favorable to the gold market than whether or not there's an interest rate cut or not. I think the Fed, first of all, let me say this, Danielle. This is kind
Yeah.
of important.
Yeah.
There's a dual economy right now. The upper echelon, the 10% that own 86% of all American assets, they're doing very well. To them, the economy couldn't be better, especially where they have a lot of their money invested in markets and things of that nature. The next 40% that own the remaining 14%, some are doing good, but some are falling to that lower echelon. And then half of America that owns no assets is struggling a lot. Eventually, the economy gets weighed by what the bottom is doing or not doing than how much the upper echelon could do. So to them, an interest rate cut of worthiness of 2-3% could be the difference of whether or not they can pay electrical bill or a mortgage payment. We're seeing delinquencies in cars going up. So I think the Fed keeps that in mind, will have that more in the mind. But I also think it backfired at Trump being so heavy on him, because I could see Powell not doing one here now just for the express purpose of 2 more months of Trump not getting his wishes. So you're not supposed to be political in the Fed, but I can't imagine, just like umpires sometimes favorable certain teams, whether they're trying to be objective or not. I think the Fed has its own political choices as well, and Powell's never been a fan of Trump. Other than an extremely oversold condition, with the most crowded trade existing right now is short the dollar, and that's why a little counter trend rally should be happening. But let's not forget the first 6 months were one of the worst 6 months ever for the dollar. And
That's
whether you
right.
like it or not, and whether or not people don't want to understand the dramatic breakaway from the United States as a world leader economically, socially, politically, and all, we're continuing seeing slowly but surely that shift away from the dollar occurred. The BRICS did not fold up and die. They're growing. Their talk of how they're about to implement trading among themselves grows, which includes the Shanghai Gold Exchange and what's transpiring there, along with the BRICS. So anybody that thinks that the dollar has a lot of upside to it, I think is making a poor mistake. And quite frankly, it's one of the several bullish reasons why not only has gold gotten to where it's gone, but why I think it can go higher as well. We still see, even as recent as this last few days, Newmont Mining, the world's largest mining company, knocks the
Yep,
ball out of the park.
you're right.
Uh, Free cash flow records, and the sale of the GDX, which Newmont is a key part of, continues to be liquidated, not bought. So I'm certain there was bullishness at that seminar, but overall on Wall Street and in the financial community, they're still treating gold as kryptonite the same way they did when it was 1300, and also now, at 3,300,
You're
3,400.
absolutely right.
So I just think that the near perfect storm that has formed for gold, silver, copper, and uranium remains, and things that Trump is doing are bullish for all four of them. So that's why I remain so constantly strong in belief of those metals right now. If you don't mind, Daniel, this is kind of really important. So I'm old enough to remember a guy named Robert Prechter Jr. before anybody knew who the heck he was. He came out in the early 80s. The Dow had just traded between 700 and 1,000 for 13 years. Wall Street was so bearish on stocks at that time that Business Week ran a front page cover, "Equities are dead." And on the old Wall Street Week with Louis Rukeyser, they were debating how it's going to be so hard for the stock market to go up. And this guy comes out of Gainesville, Georgia. No one knows who he is. And he says the Dow's going to 3,600, and it's going because of some Elliott wave theory that people didn't know about at the time. There's this still thinking in the gold business that somehow it should just be somewhere between 1,000 or 2,000. Yeah, a couple of reasons why it got ahead of itself, but it can't really go to 5 or 10,000 or 15,000. And I don't sell it. I don't have anything product that because gold goes to 10 or 15, I make more money other than I invested in the companies that look for it and produce it. But the bottom line is, I think we got to get rid of that thought and think that, yeah, that is legitimate. So when you say 4 or 5,000, or banks are talking about that, just look over what's happening in Asia. As we shop and spend money we don't have on the weekend on products we don't really need, the Chinese community is in stores
You're
physically
right.
and
You're
encouraged by
right.
their country to buy gold.
In the interview, Peter Grandich warns that U.S. debt is spiraling out of control, with projections of $50 trillion within 8 years. According to him, even modest interest rates would create unsustainable interest payments, crowding out spending. He stresses that long-term rates are crucial, especially for mortgages and debt refinancing. Grandich suggests Trump may eventually use gold to back treasuries to restore investor confidence. With U.S. budget deficits running at their highest since 2021 despite some increase in tariff revenues, a surge in government borrowing is likely to place further upward pressure on long-term interest rates. Even if anticipated Fed rate cuts in the second quarter of 2025 help contain short-term borrowing costs, this combination sets the stage for a higher term premium. Sharp debt growth sometimes mirrors historical debt crises. Japan's 260% debt to GDP model offers a cautionary tale. As governments struggle to service liabilities, their fiat currencies come under pressure. With U.S. gold reserves representing just 2% of debt liabilities, any escalation in debt worry could trigger a material re-rating of metal prices, especially in a high debt to GDP environment. Let's get back to the interview.
I started working on Wall Street in the dinosaur age of the early 1980s. And we didn't know what a trillion was as an advisor. We didn't have to use it for anything. There wasn't a trillion debt. There wasn't a
Right.
trillion of anything. We couldn't even tell you how you add up to a trillion.
Right.
Now there's, 37 trillion. We're seeing an acceleration. Let's not forget, just a few months ago, every hour there was a social media post from Trump and Musk from the White House or
Yep.
somewheres how deficit reduction is going not only going to occur, but we're going to pay down the debt too. And what do we have a few months later? They couldn't even they struggled to get $9 billion in reduction while they passed a huge bill that now people are starting to recognize when they read it and see it that Social Security, which many people thought could at least last 10 years without any major changes, now is shrinking to as little as 5 or 6 because of that bill. So the argument about this debt is this: if the Congressional Budget Office, which is really the last bastion of any impartiality, if there's such a thing still in Washington, D.C., says now we're going to 50 trillion in less than 8 years in the debt without taking into account a potential recession or even something worse. So let's just say they're right. They've been right so far. We've seen the tremendous growth in debt. There's nothing happening now that suggests anybody's going to slow it down even, let alone stop it. So put a 5% interest on that. Listen, you and I, especially me, are old enough where 5% used to be a very low interest rate. But 5% is a little bit higher than we've been in recent years, but not high. That's 2.5 trillion in a known interest expense that's going to have to be paid. The best this government has ever done in revenue is just a little under $6 trillion. And if you get some growth there based on, supposedly tariffs or whatever he's claiming now is going to add to our economy and all, we're getting to the point where people, they don't even consider about any of the debt being paid back. Can the interest expense be paid back? And here's the thing you'll be talking about in the coming months about the Fed,
Okay.
whether they cut the September, December, whatever. If you and I are blessed enough to be on this earth a year from now, we will see that interest rates on the short end might be actually lower than they are now, but the long end could actually be higher. And that's going to be the dramatic change in the
Uh-huh.
bond market, that you could see long rates increasing despite the Fed cutting rates on the lower end, because concerns now worldwide, particularly since we depend on foreign investment to support our debt spending, is leaving us. We're seeing people paying less heed to our debt. We're also seeing competitive markets in serious trouble. Overlook what's happening in Japan and what's happening with their own bond
Absolutely.
market, a
Absolutely.
real critical economy. So interest rates, when you say, yeah, interest rates can go lower and you'll turn on a financial media that's all they talk about, they could be right. You could have the short end lower, but it's the long end which is going to matter. And people must remember this, Danielle. As much as we like to talk about the stock market, the bond market is so much bigger and more important longer term than the stock market, yet we don't focus on it that much. So I do think that, and I understand what Trump's trying to get at. Listen, 2 or 3% lower overnight would lower some of the borrowing costs. It certainly would lift markets that are really in trouble now. The auto business, real estate, they're hurting really bad. And maybe a 2 or 3% somehow magically lower helps. But I just think the damage is done already. So I hate to be bearish, but it is, to me, seems to be the prudent road to take. Well, first of all, let's face facts. Mortgages, which are probably the most important thing, that more people have mortgages probably next to car loans, wherever they run, part 1 and 2, are based on what long rates are, not what the short rates are. So that's a critical factor. The borrowing, the mistake that the couple previous administrations made, the little lady that used to be in charge of the treasury and then she was in charge of the Fed at one time, when they had the opportunity and when rates were so low, almost down to zero, instead of refinancing the short end of the markets and make it all long-term at 1 or 2%, she let an entourage that just borrowed more money on the short end, which, yeah, for that time gave them lower costs. But now so much of that debt is becoming refinancing. Not only is 9.5 trillion coming due this year, but almost 28 trillion of the 37 trillion in the next 3 year has to be refinanced. So you start talking about 1 or 2% differences, that's a lot of money. And that's one of the things that also leads me to believe that and I'm not the first to say this, Daniela, but that come next year, Trump is probably going to use gold in some way to back treasuries because that's going to be
Yep,
the thing people are going to want to have to be willing to risk the possibility now that not only is my principal never going to be paid back, but you guys might start having problems paying the interest. So I want some security behind that. So I think
absolutely.
that'll be the big thing come, July of next year, that the gold market will be used to help fund some of our deficit spending.
Global debt has surged to record levels, topping $324 trillion in the first quarter of 2025, a $7.5 trillion jump in just 3 months. As governments borrow more, investors increasingly turn toward hard assets. This rising global debt is shifting investor behavior toward precious metals such as gold and silver. The 2025 autumn rally is beginning with exceptional momentum in gold prices. Gold has already surged 29.1% year to date, reaching unprecedented highs above $3,400 per ounce. This strong performance has created a bullish technical backdrop that could attract momentum-focused investors. Concurrently, gold prices surged to a record $3,500, with institutional analysts like J.P. Morgan and Frank Holmes predicting further gains to $4,000 to $6,000 amid monetary expansion and trade policy shifts. The Federal Reserve is expected to leave its benchmark interest rate unchanged within the 4.25% to 4.5% range, despite persistent calls from U.S. President Donald Trump to lower borrowing costs. Traders continue to price in a possible rate cut in September. Expectations of looser monetary policy are contributing to bullish sentiment for gold, which has already gained more than 27% this year, outperforming most major asset classes. Gold mining stocks typically magnify gold price movements by a factor of 2x to 3x due to their operational leverage. This amplification occurs because miners' profit margins expand disproportionately when gold prices rise. For example, if a miner has an all-in sustaining cost of $1,200 per ounce and gold rises from $3,000 to $3,300, the miner's profit margin per ounce increases from $1,800 to $2,100, a 16.7% improvement, potentially increasing earnings by 20 to 30% with just a 10% increase in gold prices. The World Gold Council's Gold Mid-Year Outlook 2025, based on its gold valuation framework, indicates that if current market expectations hold true, gold is likely to trade sideways with modest gains of 0% to 5% in the second half of the year. However, the economy often diverges from consensus forecasts. If financial conditions worsen, intensifying stagflation or geopolitical risks, safe haven demand could rise sharply, potentially driving gold prices 10% to 15% higher. Most analysts believe that central banks remain the bedrock of gold's rally, driven by the long-term diversification of reserves away from dollar dominance. China has added to its reserves for 8 consecutive months, while an ECB survey showed that nearly 2/5 of central banks cite geopolitical risk as a reason to hold gold. As the world edges closer to a debt-driven inflection point, will gold once again prove to be the ultimate anchor in a sea of economic uncertainty? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.